Hello, this is Professor Hazard again, and this is the fifth and Wahoo final video in which we finish this valuation, and it may be the shortest one too. Now, in the last video, we did a schedule of assets, and we used that schedule of assets to build our free cash flow, and that it does. Now, notice what we've got: 5 years free cash flow. We'll consider that to be our super growth period, even though this company, as I've said a couple times, isn't really a super growth company. Um, we're doing this for format. Um, and so we're using the same basic two-stage model that we use for the short form valuation. First, we have a stage, super growth stage, and then have a constant growth stage. Okay, so what I'm going to do is, and one of the reasons you do a quick short form calculation, first, it's to give you an idea of where the company stands, but it's a general idea before you start the big one. And then even after you start the big one, then you start putting in more detail, but that's beyond the scope of this course. Okay, so let's do this. Since we're going to use we're using the same two-stage model basically, but we've got more detail in it with pro forma. What we're going to do is let's go ahead and use basically the last part. I'm starting here with the step 3 here of the short form, and we use this as a template to finish our long form valuation. So we'll just go ahead and calculate it down here, and I'll put here calculation of share price. So the fourth section of this thing after financial statements, assumptions, income statement, the income statement, balance sheet, calculations, financial statements. Calculate. Okay, and so what we can do is go ahead and maybe put some spaces here. We'll bring the assumptions down. Let's go ahead and copy the assumptions down from the top. Not always a good idea, but I'll do it here because this is not a full class of financial statement analysis. What I'm going to do is just go all the way up to the top and just copy my assumptions down. Those are the assumptions that I'm going to be careful with this. I'll tell you why later. So let's go ahead and copy those down to here. And right there. I don't know if I left myself enough space. We'll put some rows in here. Rows in there, and then I will move this here. And even though I'm copying those down for convenience purposes, I'm going to go ahead. I want to emphasize one thing. Make sure that they equal, that you make sure that they're equal to your initial inputs, because one of the purposes of building pro forma statements is to play what if analysis. These will be limited because these are basic, but I'll still show you at the end a couple of what if analysis types you can play. And unless these numbers equal, and we're equating them when we're using them at the bottom, then you're going to change to your growth rate. Your bottom price won't change. Okay, so let's make sure those numbers equal. Okay, so now we're ready to do our final valuation. And we've got two stages: super growth stage right here, and we've got the terminal value period. This is going to be quite easy because all we're going to do is copy more or less what we did in the short form calculation. But we're going to use the numbers. The numbers we're going to use are coming from right there. We're not going to use its growth rate. We're going to use numbers that are growing more or less. The growth rate should be more or less, but since we used the individual financial statements and we kept some things constant, then the growth is not going to be linear in this case. And we don't need a year zero here. What we're going to do is the free cash flows are going to be these free cash flows that we calculated um, up here. So they're more financial statement oriented, and these are basic, it's a base model, but if you do this in real life, you would see some true differences between this and the short form calculation. Okay, and so those are going to be our cash flows. Now our discount factors, you know that free cash flow, we don't have to worry about the super growth rate here, because we've already got our free cash flow numbers in directly from the financial statements. Incorporate that number up in the revenue. The first item was revenue, and we grew at 3.7%. And a lot of the items we associated with revenue, but others we kept constant. And so it's not going to be exactly 3.7%. Okay, but it is, you know, it is the 3.7% is embodied in the revenue growth. Okay, now the number that for our discount factor is going to be the cost of capital for the super growth period. I'm just saying 6%. And then the present value calculation is going to be the same formula that we use for the terminal growth period. Terminal value is going to be 1 divided by 1 plus the market rate, our cost of capital, raised to year, which is this number right here. Okay, so there's your first year cost of capital. Now we've got to freeze the cost of capital just like we did for the short form valuation. Okay, and we will bring this down here, okay, and that gives us the value of our free cash flow of our super growth period using the template. And now, because we use this template, some of this stuff should carry down, okay. Now the 6-year growth rate should be equal to that times 1 plus the constant growth cost of capital. So let's make sure we change that. So this number should be equal to, because after the 5th year it's only growing at 1%. This number times 1 plus constant growth cost of capital there. Now this number should equal your denominator, and your denominator should equal the difference between cost of capital and the growth rate. I brought this down in a sense. Okay, notice that we're taking our 6th year cash flow, because we grew the 5th year by 1%, and we're dividing it by the difference between the cost of capital and the growth rate. Okay, and then if we do that, it gives us $339 billion. But that gives us, that's the present value, all the cash flows from year 5, the end of year 5 to forever. But since that is gives you the value of those cash flows at year 5, we've got to discount it back by 5-year growth rate to get the present value, the value at year 1, year 0, which is essentially your present value. Okay, so then this number is the sum of those two numbers. And we just got to find the number of shares, and we will see what we get. Okay, so no, just the number of shares were up here in the income statement. You just go up to the income statement, and it's take any one of these, they're all the same, we're assuming they're the same. So we're getting a price of $52.38 per share for Pfizer. That's not a bad valuation, actually. Keep in mind, it's going to be high. I can tell you it's going to be high because we did a valuation of the assets. We haven't subtracted out the liabilities. If you took out the value of the liabilities, this is the value of the assets per share. If you took out the sum of their total liabilities, that number would be driven down. And so it's just looking like a reasonable number here. I'll go ahead and save this now. And I'm going to do 3 things before I go live here. Let's look at some internet stuff on the current event. Let's go to Yahoo Finance, or we'll just go to Pfizer stock price. Pfizer stock price is $38. So we're getting a stock price of $52. Pfizer's trading at 38. We know that we haven't taken out the liabilities, so we know right off the bat that this price would come down maybe by $8 or so. I'm just guessing. So you're looking at $44, and there's probably other adjustments, but so the value looks good. So if we went further, we would take out the liabilities, which is another course, and we probably come to the conclusion that the stock is fairly fully valued. And if it's trading in a narrow range, which Pfizer generally does, because it's a slow growth, mature company, then it might be a good investment as a dividend paying stock. And that's the conclusion we came to. Now, the last two things I want to emphasize, and do this before you send your final in. Make sure this price changes with changes in the growth rate, because I'm limited in my ability to do this, but you use pro forma financial statements to uh, to see how the price changes with this change in certain parameters. So let's say that we changed. We were dealing with $52. Let's say we change our growth rate assumption to 5%. You see, it all works through. Let's see what happens. First of all, make sure that your balance sheet balances under the new conditions. It looks like it's 228 and 228. So our balance sheet balances, which is a good sign. And let's see what the new price is. It may be lower. Sometimes it's lower because you have to reinvest more. We went up by $3, so it looks reasonable. If our growth rate went from 3.7 to 5%, our price went up by $3, which makes sense. You'd be growing at a faster rate. Okay, so that makes sense. Now let's go ahead, and I'm undoing that. And here's another thing you do, and this is why advantage is meant. Let's say that you have cost of sales. Let's say that for some reason or other your costs went up, and there's going to be inflation in the world coming up. In case you have to read the papers, there's a lot of inflation because of semiconductors and the price of raw materials is going up. There's a lot of demand for things in the world now, which is going to be maybe red hot economies and red hot inflation. But anyway, let's say our cost of sales went up, whatever reason. Let's say that the ingredients of the pharmaceuticals went up. So let's say they went up by from 20% of sales to, and you can change the percentage here to 30% of sales. Now that means, and it doesn't, you don't have a gross profit line, but that means that your gross margins went down. And since your gross margins go down, it should also mean that your share price go down. So notice that, and let's see if it works. If it doesn't, that's just accept it. Notice how much your share price went down. Notice it went from $52 to $19. So notice how valuable those high gross margins are to Pfizer. The only thing I did, I changed the it's not a minor change, but I changed the cost of sales from 20% to 30%, which obviously decreases the gross profit, which you don't have a different line for. That's okay. So notice the sensitivity of the price to changes in the cost of sales. So let's go ahead and let's say that they got more efficient and they are super efficient and the cost of sales went down to only 15%. So they had gross margin of 85%. So that would be super. And notice that the price, how this goes up from $52 to $75. So one of the things I'm including is that that Pfizer, given their slow growth, their margins are absolutely essential to maintaining those nice dividends, which are basically the source of their share price. That's the sort of thing you can do. You can also look at R&D expenses, and they're gonna be very sensitive. You're gonna get the same type of change. Let's say they increased R&D. Now this is where you have to make additional adjustments because R&D can also be seen as an investment, not just expense. Let's change. Let's just change. Say that they became more efficient in selling and administrative expenses. So let's say that they became less efficient in their producing their goods. That's another type of accounting. But let's say this went up by 25%. They said, oh, our cost of sales is going up by 25%, but so we've got to lay off some accounts. Let's say that resulted in 25% to 5 administrative expenses. You can play around with this and let's see how the share price would change. The share price would now become $44. So the value of those two changes would actually decrease your share price from 52 to 44. So I'm going to go ahead and undo those changes because to get you back. But that's the sort of thing these statements are built for. These right here are kind of limited because mainly because of R&D. This company has huge R&D, and that's, well, as a percentage of sales, it's um, pretty big as a percentage of sales. Let me change that back. Let me change these two things back here before I forget to give us our $50 sales price. But R&D, you really have to take a look at that, because in American accounting standards, the U.S. accounting standards, they're all expensed. But in international standards, they're considered investment. So actually consider them like a fixed asset. So it would change the dynamics of this whole thing. But anyway, I'm just showing you the things you should be able to do with this. Anyway, so I'm going to place this up, and that is it. And if you do this for Lily, and there will be questions, we'll have a couple of short office hour periods, and then that'll be your final. You know what you have to do. But this, really think about this. This includes so many. This includes, the articulation between the financial statements. It includes fixed assets, obviously. It includes this sort of the adjustments in a sense. I didn't make them, but you had to consider your working capital as a percentage of sales. It didn't relate it to cash flows, but it includes, you got your basic idea of free cash flow here, which is sort of a mini statement of cash flows, and income plus depreciation less your properly planned equipment. If we threw in working capital adjustments, you'd have a mini statement of cash flows. Here's your fixed assets, and you could actually start, playing around with inventory turnover and things like that. You can actually incorporate different ratios into this. It doesn't take much imagination to say, let's assume our inventory turnover so much, and incorporate it into your inventory numbers and see how that impacts your price. That's the sort of thing that's used for a lot of. You got your full statement, so you can do all sorts of scenarios, see uh, how different changes in revenues and expenses impact share price. Anyway, so I'm going to put this up, and that'll be it.